Appreciate that. Good morning. I'm Michael Boralski. I lead the Regulatory Services Group for U.S. Bank Global Fund Services. We're a back office provider of custody, administration, series trusts, and other services for registered and private funds, including about 500 ETFs for a little over 100 different sponsors. I've got a great group of friends from the industry here, so as Jim said, we're going to do a conversation about bringing funds to market, do some myth busting, and kind of get into the details on some pretty fundamental topics that are important to launching ETFs. So let's do some introductions. Rob.
Appreciate it. Ooh, can everyone hear me? Great. Very nice to see everybody again in person, live, post-COVID. Rob Morocco. I look after our global ETF listings business for Cboe Global Markets. We're a stock exchange operator, operating ETF listing exchanges in the US, Canada, Europe, and Australia. And so looking forward to the conversation. Jenica?
Okay. Hello, everyone. Jenica Ross. I am with Susquehanna International Group. I am head of U.S. ETF sales and portfolio trading. So Susquehanna, or SIG, is one of the leading market makers globally. We trade nearly every one of the U.S. 3,000 plus listed U.S. listed ETFs, as well as serve as the lead market maker for north of 400 products and provide seed capital for clients who are looking to launch product.
Hello, I'm Jim Kaiser. I'm a partner at Cohen & Company. Cohen & Company is an audit, tax, and advisory firm with a particular focus on the investment management industry. We do work with a lot of registered products. We are the second largest provider of audit and tax services to ETFs. We work with a lot of startup funds and see a lot of things. Happy to share some of our experiences with you today.
Awesome. Okay, we're going to start with tax. Not because it's the sexiest of all topics. Sorry, Jim. But because it's one of the most common reasons that we hear advisors citing for why they're interested in getting into the ETF wrapper, why they think it'll benefit their clients, et cetera. And what I really want to start with is what I occasionally hear from new advisors or sponsors coming into the space. And what I hear them say is, I want to do an ETF because ETFs don't pay taxes. Isn't that amazing? And I can already see the lawyers and accountants out here cringing. And I dare not field that topic, but I don't travel anywhere without a trusted CPA. So, Jim, you want to talk about what's actually going on with ETFs when people talk about tax efficiency?
Yeah, sure. So, full disclosure, I'm an audit partner, not a tax partner, but I'm dangerous when it comes to taxes. If you want me to cite codes, I'm not your guy, but if you want me to explain in layman's terms, I'm your guy. So, what happens with ETFs, and I think many of us probably know this already, but there is an in-kind mechanism with how the portfolio is traded or how shares are created, where securities are transferred in kind in exchange for shares of the ETF. And those transactions are not recognized for tax purposes. If you conflict that with your traditional mutual fund, the mutual fund is taking cash, buying securities. When there's redemption, they're selling securities, giving the cash to the redeeming shareholder. When you sell the securities, that is a taxable transaction, creates taxable gains if the portfolio is going up, that you then have to distribute to the remaining shareholders. An ETF, because of the in-kinds, the ins and outs of the fund are generally done in-kind. Those gains are not recognized for tax purposes.
So not fair to say they just don't pay taxes.
Yeah. Though they can. You certainly can have ETFs that, well, backtrack. They're probably not paying taxes because they're generating taxable income and distributing that to their shareholders. In some cases, if it's not effectively managed, or if you're not taking advantage of all the tools that are available to the ETF to limit those taxable transactions.
Okay, so tax efficiency is one of the things we hear people talk about a lot, but there are other attributes of ETFs that advisors are particularly interested in. And one of those has to do with the intraday tradability and liquidity and the ability to reach audiences and places that they might struggle with either through SMAs or mutual funds. And one of the places where I think education is most important for new entrants are some of the players involved with ETFs that you don't see for unlisted products. So, Rob, I'm going to turn to you here, and the question is really, what is a listing exchange? What is it doing? And what do advisors or issuers need to understand about that relationship?
Absolutely. So maybe at just a high level, what does the role of the stock exchange play for ETFs? It's definitely the E of the ETF equation. The role of the exchange is twofold. One, first and foremost, it's a regulatory function for the listing. It's that a fund or company meets a certain set of criteria, meets the listing standards of the exchange, has complied with SEC registration, and the exchange is technically a self-regulatory organization, has the ability, again, if the company or fund meets the criteria of the exchange, in order to list on a national market. And again, very similar role in the US, abroad. Same thing. The second role of the exchange, besides the actual listing venue and playing that regulatory function, is to maintain and operate a fair and orderly market. So looking for folks that only have mutual fund experience or have mutual funds that you only have that primary market activity. With the ETF now on exchange, there is the intraday tradability, there is the secondary market, and that is what the exchange focuses in after we actually get the product on the exchange and listed. What does that market look like? What do we define as market quality? How do we incentivize market participants, like Susquehanna as a market maker, to make and maintain fair and orderly markets on our exchange? The best way to think about it, again, we're a store and we have shelf space. And this is where, at our core function, we are bringing together buyers and sellers and pairing them off on the exchange. So again, whether it's an ETF, whether it's a single stock company, that is the primary role of the exchange. Again, fundamentally. Now, when we look at ETFs and where does the exchange come in, and we see it as really our mandate, is how do we help educate? How do we help educate folks from a trading standpoint? How to best execute and access the products that we put on our shelves? How do we better educate around potential, in partnership with index providers, with ETF issuers, better educate around the investment strategies that are inside the vehicles? And again, one size does not fit all. A US equity ETF that holds S&P 500 constituents is going to look, trade, feel different than a fixed income ETF. It is not one size fits all. And so really that is where the team is working and constantly looking, what do we mean by market quality? How do we continually enhance the end investor's experience when entering or exiting a position of a listing on our exchange?
Okay, now you mentioned lead market makers. What's a market maker? What's a lead market maker? Are there following market makers? This is a whole role that most people outside of the ETF space have never heard about, know nothing about, and need a lot of education to understand how they interact with ETFs, what their role is, who they work for, all these kinds of things. And just so happens we have one with us today.
You do.
So Jenica.
You do. Well, let's start at the market making level, right? You have a range of market participants that are out there on exchanges providing liquidity to investors. They're doing it every day. That's their business. That's how they make money. There's an additional component, and those could be banks. They could be firms like Susquehanna, Jane Street, GTS. There's a lot of us here in the room who serve that function. There's market makers that are not client-facing. They're names that you probably wouldn't ever know. But we're out there and we're incentivized. It's our core business to provide liquidity to investors, to hold inventory, to make it available, to make spreads, and for our business. In addition to that, there's the function of the lead market maker. And where that comes into play is, I think a lot of times there's a misunderstanding with what the lead market maker is. It's actually just an obligation. It's an obligation when we sign up as a lead market maker with one of the exchanges to make sure that we are providing a certain level of liquidity and spread to those new products as they come to market. So it's a really core function, just like you're going to engage with the correct level of service providers. Engaging with the lead market maker is not just to check the box at the end prior to launch. It's a function that you should be engaging with when you're bringing new product to market fairly early in the process. Oftentimes, it's actually a pretty critical component to be engaging, even at the portfolio management level decisions, when you're finalizing the nuances of what the portfolio and what the construction and what the operational workflow of the fund is going to look like. It's at that point that you'd want to start engaging with a lead market maker, because there are nuances that oftentimes from a portfolio management decision-making process you wouldn't take into consideration that can have significant significant consequences into the appetite for someone like Susquehanna or one of our other lead market making firms to step in and want to take on the obligation of supporting your product in the secondary market. So I think that's one thing that we oftentimes see with the effectiveness of a product that's coming to market, especially something that's a little bit outside of the box, something that might include some derivatives, something that might include an international component to it on the fixed income side. There's oftentimes some suggestions and tweaks that we can do that will allow you to achieve your investment objective within the fund, but will make it easier for us to price and our peers to price, which is what you want. And the other point I would have within this space is oftentimes I think people come to the market with new product and they say, okay, I've got my lead market maker in place, I'm all set. Yes, that's a great first step and it's something that you want to do, but you also want to make sure that you have another universe of market makers who are not your lead market maker, who are also very comfortable to step in at the beginning and price your products. So Susquehanna, 3,000 products out there, 400 products or so that we're lead market maker for. If we're not comfortable with your product coming to market, we're not going to add it to our pricing responders, we're not going to be providing liquidity, and it's that breadth of market participants that you have supporting your product that increases the likelihood that you're going to see sort of the liquidity profile that you would ideally want for your product. So I think, from my perspective, engaging with the lead market early, and then also making sure that you look beyond that and have other market participants who are comfortable to price your product at the beginning.
So if we're talking about an advisor bringing an ETF to market for the first time and they want to go meet with a lead market maker, what do they need to be prepared to tell you and what kinds of questions are you going to ask them?
Yeah, I think it's, we actually put on more of like a portfolio management hat, right? So what are you trying to achieve with this product? Sort of what is the strategy itself? What are any specific mechanisms that you might have within it that are more nuanced, something that we would need to be aware of? Probably maybe the second question, sometimes they even ask this first, is tell me about your distribution strategy. Tell me about what your plans are with this product. Who is this going to resonate? Where are you planning on sort of what investor appetite? The answer to that, the nuances of it, I honestly really don't care what the answer is, but I want to know that you have a plan. I want to know that there's a strategy because it ensures that we're all aligned. As products grow and as trading increases in those products, it benefits you as the issuer, bringing product to market. It benefits us as the market maker. So we are very mutually aligned to have products that come to market that are successful.
But Jenica, you just list on the exchange and it sells itself.
You ready to take on a whole lot of new product?
I can't echo Jenica's comments more profoundly, especially when it comes to new product development. Have the conversation with a market maker early, because we see time and time again as folks go through the product development process, they have their product, it's fully baked, great, they worked with US Bank and Michael with the SEC, they have an effective registration statement, and they never spoke to a market maker. And it's time to launch, and they can't pull the trigger. They can't get the product out to market because they never spoke to a market maker, and there's fundamental problems with the portfolio management. There's fundamental issues with how do you price some of the instruments effectively within the ETF. And so really as a sanity check, as a gut check, very early on before spending any money, have a conversation with the market maker to fully understand, is the investment objective achievable within an ETF wrapper? As much as I'd love to sit here and say everything should be in an ETF, probably not reality. Some strategies, just where we are today as a marketplace, between market structure, availability of data, etc., maybe isn't perfectly suited for an ETF wrapper. And so I cannot put a pin in that point earlier on, because at the end of the day, not only do you want to make sure that your end investors are having a positive experience when they're coming in and out of the product, that on-screen liquidity is two things. One, obviously, how you actually access a position in the product, but it's another form of marketing. If your product comes to market and the spread is massive, there's no size, there's no depth at the inside quote, no one's going to touch the product. So it comes directly back to that question around distribution. It is not just simply, oh great, I have a market maker that puts up a quote on the exchange. It is fundamental to the distribution conversation for the product once it comes to market. How does your product trade? What is the on-screen liquidity? And again, if an advisor pulls up your product and there's no size and there's a very wide spread, it's another form of marketing. They're never going to touch the product. So this is why it is so imperative to have that conversation.
So I'm going to ask you, Rob, the same question I asked Jenica, which is when you meet with someone who's introducing a new product and is new to the space, what are your expectations for that conversation and what should they know? And before you answer, I ask this because when we meet with firms that are brand new to this space and tell them they should go talk to an exchange or talk to a market maker, the fear you see in their eyes sometimes, they just don't have a concept that this is a relationship business. I think most of the people in this room appreciate that in this space, relationships matter, and you have to work with a lot of people in order to drive a successful business. So when it comes to dealing with an exchange, what's the conversation like?
Well, we start out really beginning looking at the product. How new and novel is this product? Is it something that, again, we know we can list pretty easily, pretty generically through that regulatory hat? We put on our regulatory hat first. New and novel, say spot Bitcoin elements that are new and innovative. Probably add some time on and complexity. How do we bring that product to market? Because most likely we will need to engage with the regulator in that jurisdiction. That aside, great. The product's fully baked, ready to go for prime time for the listing. Immediate next question: where are we going? Who are we partnering with together from a market making perspective? That as I've alluded to and outlined, key critical. Thirdly, who are you selling this product to? Because I come back to my earlier point, well, I just list on the exchange, it sells itself. It is not the case. It might have been the case when there was 100 ETFs in the US. There are 3,000 plus products in the US today. Who are you selling this product to? Having a really clear definition of who the day one client for the ETF is versus day 365. That changes as you hit certain AUM thresholds, as your product has track record, performance ability, etc. Really understanding going in eyes wide open, who are we selling to day one? Because if you can't really define that, you should take a step back and really think about the sales and distribution plan, because that is the key to everything. The actual manufacturing of the ETF, tried and true, 30 plus years now, we're golden there. It comes really down to how are you selling, who are you selling to, what channels of distribution, and how are you able to articulate that answer. And again, the day one client versus day 365. They are different clients. How do you achieve those milestone threshold?
So when you talk about a day one launch, we get to the question of seed capital. And sometimes people come to a product and they have existing clients and SMA assets or otherwise that they know are coming into the fund. But if they don't, I don't know, Jenica, what could you advise someone on how they need to think about bringing a product to market and where they're going to get seed from if they don't already have it?
Yeah, I mean, there's a number of avenues that you can go to get seed capital. You know, sometimes it comes from an external partner like us at Susquehanna. Sometimes it comes from an external relationship that your firm has, maybe an investor in your business that is interested. Sometimes products come to market because they are an idea from, you know, an internal client that you had, right? Hey, I'd like you to launch this strategy on my behalf, and I'm willing to commit capital to seed this product. Or I'm going to roll my capital from a mutual fund or SMA with you into the ETF structure, what you have. The main thing with seed capital is obviously that there's different avenues to get it, and there's different sort of consequences of the decisions that you make based on where you go for seed. From everyone's perspective, we know where rates are right now. If it's coming from an external partner like Susquehanna, there's a cost to that. You don't bear it directly as the fund manager, but we think about that when we think about taking on new product. If you come to us and say, hey, we need $5 million to launch, you know, this new product, and we talk through all of those other things that we've discussed, there's a distribution strategy, there's investors lined up, you know, oftentimes that's not a very difficult conversation for us to have, and it's pretty easy for us to allocate that capital. Then the investors start to come in and to take us out of that seed capital, and it's typically a couple days, a couple weeks, ideally not a couple months, but there's a process to put that into place. Where there's an issue is if there's not that distribution plan and it's indefinite and we don't have very clear articulation of what that plan is for investors to come in and take us out of our seed capital, that's where you start to have issues. And that's going to be where you start to get pushback. So again, it's a reoccurring theme, but have that distribution strategy lined up very specifically. We really do want to know exactly where those first allocations are going to start to come from, so that we have confidence that we're not going to be sitting in that seed position, you know, for a prolonged period of time.
So is it fair to say that advisors should understand if Susquehanna or another market maker is going to provide seed for a product, it's not a true economic investment because you think it's a great idea and that's where you want your capital? The business is different for your end.
No, it's flat out a cost. I mean, it's a cost for us, right? I mean, so we're doing that to invest in people that we are partnering with across our businesses. We are doing that to be involved in new products that we believe that are going to trade, which again is our core business. So we're allocating seed capital to people that have a plan in place, that there's going to be the opportunity for us to get out of that seed position, and there's going to be an opportunity for us to partner with that advisor, with that fund manager in multiple different ways.
So more and more, we're having conversations with advisors who have capital from an existing product or existing clients and are looking for ways to take advantage of that capital and port it over to an ETF. It could be capital coming from a mutual fund. It could be capital coming from separately managed accounts. So Jim, I'd love to get your perspective on what are you seeing advisors doing to utilize existing capital, and what impact does that have on those accounts or those shareholders when they go along for the ride there?
Sure. We've seen a number of SMA to ETF conversions now, and I think we're going to see a lot more of those. The first question we always get, I'm surprised, I've been on a number of these panels and I say it every time, I'll keep saying it because I keep getting this question, is no, you don't get step up in basis. so that's number one question. There seems to be this thought out there, if I convert my SMAs into an ETF, that effectively washes out that built-in gain in those SMA accounts. That's not actually true. What you can get from converting your SMAs to an ETF is you can, from that point forward, get tax-efficient portfolio management. So I think there's definitely an interest there. I think you're going to see more trend. A couple years ago, if you had asked me if I thought we'd see a lot of mutual fund ETF conversions, I would have said yes. I don't think we've seen that many of those. We've certainly seen some of them. That doesn't make sense for a lot of funds for a lot of reasons. You may have tax-advantaged accounts already. The strategy may not lend itself to an ETF. You may have direct shareholders, things like that, where you really can't. That makes the conversion challenging. But I do think we're going to see a lot more SMA conversions. There are some things you have to be mindful of if you're going to do that, and do that in a tax-free way for your SMA account holders, but it can be done. And I do think that's going to be an ongoing trend.
For the conversions from mutual funds, what's the impact on the mutual fund shareholders?
Really not much. It just becomes a different wrapper. It's your same investment. You can now trade it. There really shouldn't be any tax effect for the shareholder. Again, you should be able to get a more tax-efficient portfolio management going forward in an ETF product versus a mutual fund product.
So Rob and Jenica, if we're talking about an advisor bringing an ETF to market, leveraging either SMAs or an existing mutual fund, does that change anything for your roles or your interactions with that advisor?
I mean, from our perspective, obviously, you still have the lead market making component, right? Even though it's an existing strategy, it's still new to the ETF space, and you want to make sure you've got that lead market making relationship secured. That is important because it's still going to trade on exchange in a different way. Obviously, it's not trading before as a mutual fund. Obviously, the seed capital question is different, right? We immediately have a source to seed the new ETF product. Sometimes it's a function where we may still have to put up seed, and this is more on the SMA, we still may have to put up seed for one day to then allow that conversion to happen. Other times with the mutual fund conversion, it can happen sort of more without us needing to provide any capital. But I think, what we tend to find in the space, and Rob, I'd love your perspective on this, but I think there's a lot of numbers that are thrown out, right? We've seen the surveys. You see, I think maybe 60 billion, of mutual fund to ETF conversions. There's been 60 billion of assets that have been raised in that space. But people then don't oftentimes look at the next level, that layer down, that's obviously very, very concentrated with one ETF issuer. And the bulk of, I think it's about a third of the mutual funds that have converted to ETFs have seen no net new assets. And then 61%, I think, are sub 10 million of net new assets. So I think, again, it goes back to my distributions. It feels like a broken record, and it is. But the conversion process can introduce some additional distribution strategies for you, channels that you can place your product, models that you could get in that you couldn't before, but it's not a solution if you don't have the distribution plan. So I just would make sure that people don't see that 60 billion number and think that is across all conversions that are happened. It's very concentrated.
I think you hit the nail on the head as it relates to coming to market at critical mass. So now when you look at potential conversions, and as from an exchange perspective, it's a new listing. However, when you look at the conversion, whether it be an SMA or a mutual fund, the ability to port over that performance history, to port over the AUM, so that when you actually come to market in an ETF, you're not starting with $2.5–5 million. You're coming with critical mass at 30, 50, 100 million. Again, it's not just great, we listed, set it and forget it. There is absolutely the distribution strategy that needs to be rock solid. But in my opinion, when you look at these products coming to market, it changes the distribution conversation, because we're not starting at brand new, we're not starting at 0 day, I have no performance history, I have nothing to talk about. I have this product, the sales narrative is already there, and how do you build upon what the firm has already begun, whether it be in the SMA wrapper or in the mutual fund wrapper. So it's really, I view it as a bit of a catalyst to launch into a much more aggressive sales and distribution strategy than as if you had a brand new product, brand new inception, starting out from sub $10 million in assets. I view that as a different conversation. I view this as an ability, if you really leverage the opportunity correctly, to penetrate the market on an advanced timetable.
So when advisors are bringing products to market, they have a lot of questions and a lot of decisions to make. And particularly those who are running active strategies with SMAs or a mutual fund or in some other wrapper. Lately, we get a lot of questions on, gee, should I be transparent? Because for the most part, we think of ETFs for their transparency, disclosing the daily holdings, putting it up on a website for the world to see. It's a big difference from the mutual fund space. But these days, there are other options. So we, from our end as a service provider, we get a lot of questions on what's the servicing like, what's the distribution like. But I'd love to know from an exchange or a market making perspective, what's your experience been like with products that are not fully transparent, and what additional parts of a conversation do you need to have with an advisor there?
Sure. Maybe I'll speak more from the product perspective, and really curious Jenica's perspective from a tradability standpoint. Look, I view it as for investment managers, for asset managers to have more choice, more tools in the toolbox for how they bring certain strategies to market is a good thing. To have flexibility. I don't. We were the first exchange to actually list and get approval from the SEC to bring a semi-transparent, actively managed ETF to market in the U.S. Still early days, in my opinion, because the product's now coming up on 3 years. 3 years being in the marketplace, finally has 3 years of performance. So whether or not it's hard to say whether the structure is a success or failure. I think it really comes down to, again, what suits the investment objective. What ultimately, do you need transparency? Do you not need transparency? It really comes down to what is right. It's not one size fits all by any stretch of the imagination. Also today, under U.S. regulation, semi-transparent ETFs, actively managed ETFs, are only allowed to hold U.S. equity in the underlying. So you're pretty restricted to the potential universe of investments. I view the question around transparency really at the firm level, and whether or not you need it. You look at firms like ARC, who have been fully transparent for the entirety of their funds, and we've all seen what they've been able to accomplish in those products, and fully transparent, showing that what their active management is doing underneath the hood. So I think it really comes down to the strategy, the firm, and really what best suits your particular needs to operate a product.
Yeah, and I think, from our perspective, I think it's less, obviously I think across the marketplace you've seen, pretty tight spreads in most of the fully transparent ETF strategies that are out there, regardless of the underlying asset class, whether that's on the equity or the fixed income side. It's been demonstrated that it really is not an issuer for the market making community to price the fully transparent structures. Semi-transparent space, I think it's a little bit murkier answer. I don't think that things are anything wrong with what they're doing. It becomes a little bit more complicated from our perspective. But oftentimes, it's not that the structure themselves there's any issue with. It's just the information delivery to us as the market makers so that we have confidence in the pricing. So if we're not confident in how we can hedge and how we can price that, spreads widen. So I think it's not necessarily the structure itself, it's how information is delivered to the market making community to instill confidence that we can price these and hedge these efficiently and provide the spreads that people expect in the marketplace. So a lot of the times that's nuanced around file delivery times, the way that it's delivered, what's captured in those files. So working with US Bank and other providers that you have can tweak those nuances to make it easier for us, which results in a better trading product.
Another set of decisions and conversations we have is where to launch a product and with what kind of a partner. There are so many different business models for bringing a new product to market as an ETF. You've got partnering with a white label advisor. You've got sub-advisors that can be used just for trading or to bring a strategy. You've got series trusts, sometimes called shared trusts, sometimes called turnkey trusts. God, I wish we would adopt an industry label for those things that we could all agree upon. But these are a lot of different terms, and I'm going to spend just a minute talking about them because there's often a lot of confusion about what they mean. Let me start with white label, because that's a term we almost never see in the mutual fund space or with advisors outside of the ETF space. Working with a white label provider or white label advisor is a way to engage another firm to play the role of investment advisor for your product. And those relationships can come in a lot of different forms, but from a regulatory and legal perspective, it's coming in the form where that firm is the investment advisor to the product. Another firm may serve as a sub-advisor to the product or just a sponsor to the product. They might provide an index for the product, but they're not going to be the actual investment advisor to that product. That comes with some upsides. You may be benefiting from an advisor that already has a great deal of experience managing ETFs, relationships with exchanges and market makers, where the kinds of scary conversations with you folks are not so scary to them. Experience managing baskets and trading the product. So there can be upside there. And then, of course, there's a downside on the economics that comes with it, because nothing is for free. So the white label piece is about engaging another firm to serve as the advisor to that fund. Now, that's not the same thing as working with a series trust. A series trust is a place where a fund can benefit from having an existing board of trustees, existing legal counsel, and an audit firm that are overseeing and serving their roles for a group of unaffiliated products, all under one legal umbrella. It's about shared economics. It's about partnering with experienced professionals without having to give up your unique identity, your unique brand, and being able to manage your own product. And it's a wrapper that's very flexible for funds, because within a series trust, you can have a white label relationship. You can have sub-advisors. You can do semi-transparent products. You can do domestic and foreign and fixed income and equity. Basically, being in a series trust tells you nothing about what the structure of that model is really going to be. It's just another choice of how you want to partner with people and how you want to bring products to market. Another question is about using a sub-advisor. So we've seen a lot of issuers come to the market using a sub-advisor to handle the basket construction for a fund and to handle the trading of that portfolio, even if they're not the ones making the investment decisions about which securities to buy or sell or what index to follow. It's really more about the mechanics of it. And I'm curious for the three of you whether your roles change when you're working with a product that has a sub-advisor that manages these types of funds as a day-to-day business, a core function for them, versus dealing with new entrants to the business who are doing everything for the first time. Jim, why don't you start with that?
Short answer is no, it doesn't really change. I will say that it tends to make our life a little simpler if there's a trading sub-advisor. Often, not oftentimes, but many times we've had the question, hey, Jim, how come I have to pay a capital gain distribution and all my competitors do not? And the answer generally is, well, you didn't utilize all the tools to affect your portfolio transactions in the most efficient way. So a trading sub-advisor knows how to do that, an experienced trading sub-advisor. So when we see that model in place, it tends to solve that problem before it actually happens.
I mean, and from our perspective, I think It depends if the person coming to us has done an honest assessment of sort of who they are, what their business is, what their capability is, and who they want to be. If there's many asset managers out there who have the internal capabilities and expertise to do all of the things that need to be done, to have no sort of additional sort of trading partner or sub-advisor relationship. There's a vast majority of people, for many, many reasons, and it's no fault of them. I don't think it's not advantageous to the ETF or disadvantaged. They just don't have the capabilities, shouldn't have the capabilities, and should leverage a partner to provide those capabilities to make it an effective product. And it's worth paying that, and your product is going to be more successful if you engage those relationships, pay it up front, and have a product that comes to market in a way that is the way that you want it to do, the way that we want it to do, the way the exchanges want it to do. So I think it's just that honest assessment at the beginning on who you are today, and also who you want to be going forward, and sort of what the continuum of those relationships that you need to get you to that point. And it's also, I think you need to, the sub-advisory space is pretty diverse. There's different expertise at the different platforms. There's different levels of services and support that they offer you. So when you do that internal audit of yourself, and you can really identify what you need to have a successful ETF business, then you can go to the various sub-advisors that are out there and make sure that what you are asking from them is what they're willing to provide you, and that there's just the personality match. And I think oftentimes you want to be, just like you would hire an employee, and you would have people on your internal team that meet a certain personality, you'd want that from your sub-advisory relationship as well.
Ultimately, I think Jenica's point is the core one. What are you best in class at? Do you have the internal resources to properly manage a product all the way through, to take a full accounting? What resources do you have internally? Does it make sense? Build or partner? And I come back to, depending on the firm, the DNA of the firm, the core competency, the core investment objective, that really begins to answer itself. What are you best in class at? Don't waste time and money and resources on trying to always figure it out and build it internally. The partnering route, great room here full of so many different service providers as well as partners in the industry. Leverage where they are best in class, leverage where you are best in class, and that really dictates and is the model we've seen where folks have had most success when building product and bringing it to market.
I appreciate all that. I think we have time for maybe one or two questions. If one question. Okay, who's the lucky one with the one question? Up front. Want me to start there, or you want to?
That's why I don't run an asset management distribution group and stay in the trading space. It's a great question.
As you noted, absolutely, you don't see ETFs with 12b1 fees. That's a difference in structure. You don't see sales loads. You lose those pipelines for supporting the distribution-related expenses. But I will tell you, the starting point and the ending point is about conversations. We encourage the advisors to be out there talking to the platforms that are going to be important to them, where they have existing client relationships, finding out what those fees are going to be, finding out what their options are. And this is just as important for new products as it is for converting existing ones. Because you can't assume your existing mutual fund, for example, will be treated just the same and all the doors will still be open if you convert it to an ETF. You have to do your homework there. You have to get the pricing directly from those sources. On the other hand, it can be a little bit simpler for advisors economically, not necessarily cheaper, but most of the ETFs that we see come to market have that unitary fee structure where the advisor is the one responsible for all the expenses associated with the product. The fund pays one fee to the manager, and the manager pays all the bills from there. So it does make it a little bit easier for the manager to make decisions about what dollars they want to spend and who they're going to spend it with as they're targeting the audiences for the launch of that fund. Thank you to the other panelists up here and for your time. Really appreciate it.
Thank you.